Okay, this video is going to be a black belt model review. Now, this was done on the 16th of January 2026. If you would like to go into the Trading Camp Discord server, look into the New York AM chat, and you can find this day. You'll see everything was called in advance before the market even opened. And then we had the black bell, and we said, okay, black bell, we're going to look for the opposite end of the range, and we're going to use the first presented fair value gap. We're going to use the opening range gaps, consequent encroachment, which was lower than market price. So the sell that we took had a bunch of confluences behind it, and even though it was OPEX today, which is the options expiration, it was still a very good. Although it was a little bit choppy right at the beginning, it was still a very good trade, and as long as you had appropriate stop loss placement, you would have been fine. Okay, so this is the execution on the Nasdaq, and you're seeing a lot on the chart right now. So there's the 15-minute SIBI or bearish order block that we're working in. We have the 15th of January's AM session first presented fair value gap. That's the 950 candle. We have the pre-market high, and then you can see that the pre-market high was swept at 930. So this is 928. It trades up, it rejects this wick, and it leaves this as a pre-market high. Once it trades up again, it doesn't run this high. Okay, that's important, because once it takes out the pre-market high, it needs to be a sweep of liquidity. If it's a run, it doesn't count. If it's a sweep, then you can look for the model. So immediately it sweeps it, it rejects the 15th of January's AM first presented fair value gap. It also falls short of the 14th of January's regular trading hours new day opening gap. That is not the same as a regular trading hours opening range gap. It's slightly different. It's 4:14's closing price and 6 o'clock's opening price. You get chopped up here for a while, so there's about 1, 2, 3, 4, 5, 6, 7, 8 minutes where there's not really a lot of price action happening. It looked like it was going and going and going, and it was about to give in, but then it fell into this chop. Why would you not flatten your position when you see this? Well, because it's still working inside that 15-minute SIBI and bearish order block, and you have the 15th of January's AM first presented fair value gap there. What if you're not using this level? What else is there that can give you more confidence to hold rather than to take the trade-off? You have every time it's making a run up, it's getting flattened out. So it runs up and it gets flattened and it leaves this wick here. Then you see a full body up, it runs up and it gets flattened. It runs up, it gets flattened. It runs up, it gets flattened. It runs up, it gets flattened. So what does that tell me? Every time it wants to move higher, it's falling short from something. So if that's this PD array, if that's this PD array, or on a more immediate scale, if you're just looking at the immediate candlesticks, this is technically a bearish order block. Now, it's not the one that I would consider a strong bearish order block, but if you're not using any other points of reference, like the 15th of January's AM first presented fair value gap, or this SIBI, or you're not using intermarket relationships with ES, then you're very limited in, first of all, what you can actually refer to. But if you're only using the candlesticks right in front of you, and you shouldn't be, you should be using, other time frames, the 5-minute time frame, the 15-minute time frame, the hourly time frame, new day opening gaps, new week opening gaps, opening range gaps. You want to have these points of reference in any model because it gives you a lot more information and algorithmic points of interest where you want to see it react in a certain way, and that gives you narrative. So when I'm seeing this, it's constantly faltering at the AM first presented fair value gap. What am I thinking? I'm thinking, okay, it's weak. It can't breach this level. Every time it wants to, every time it's making an attempt into it, it's getting flattened out. So what does that mean? It's working the buy side and it's faking moves higher. It's engineering liquidity for another word. It's engineering liquidity and then it gets smacked down. You see this displacement out of this consolidation. This is where holding is very rewarding because you have to hold it for 8 minutes before anything happens. If you got stopped out here, and I know a couple people did, because they told me, you did it wrong. Your stop loss should have been at this high. There's really no other place that you could have put it. If you had it at this level, even that's too tight because it can trade up into this with one of these wicks. You see those wicks? It can trade up into the opening price here and fail at one of these levels, the rejection, and then drop. So you want to have it at the high there, at least. And then as it's getting flattened, it's getting flattened, it's getting flattened, it runs lower. You see this first printed fair value gap form. This is the only inefficiency that I consider the first printed fair value gap, because this one right before it, it's not a large enough displacement. And it doesn't really do a whole lot. It's an up candle for a moment, and it gets flattened. And you see this little body. There's not a lot of movement here. But this candle, it's a lot nicer. So that's your first printed fair value gap at 941. You have to incorporate the volume imbalance as well. It gives you an institutional for entry drill, attacks this low, which makes it a market structure shift. And from here, it's just, you have the black bell on your side. We have the opening range gap on our side, which I'll go through in a moment. We have the market structure shift. We have the fact that it's just given us an institutional for entry drill. We have it reacting to this 15-minute SIBI, falling short of that end dog, and trading up into this first printed fair value gap from yesterday and rejecting it. There are so many factors in your favor here that you want to make it, or you want to hold it for at least a pre-market low. Sometimes there may be situations where it may not reach the pre-market low and you're counter trend trading, which, although it can work with this model, I don't even do it myself because I don't want to be against my bias. If I'm looking for higher prices, sometimes I'll expect the pre-market low to be left alone. So even if there's a black bell, I'll only look for a short, tiny little scalp into about 50% of this range, which is not a preferred trade, but sometimes I'll take it if it's strong enough. When we have everything on side, like we did today, including the opening range gap, which I'll go through in a moment, there's really no reason to do anything other than take a partial and trail a stop loss. Where to? I had mine trailed here because it's an institutional for entry drill. It can work the fair value gap again and trade back up into it. That's okay. But obviously it doesn't do that. So if it wants to trade into this fair value gap, my stop loss needs to accommodate that. So it's not about where am I comfortable losing less money. I don't want to lose that much money. I'll trail it here. It's about where should it not go if I'm correct? And it should not go above this first percentage fair value gap now because it's already rejected it and given that bearish order block. You can see the sensitivity on this bearish order block. It trades up into it. It does go a little bit above. That's okay because it's only a wick. The body closes all the way down here. Then you see a propulsion block. They call all of this in the Discord, by the way. You're welcome to check. Trades lower, trades lower, trades lower. Closes below this up close candle, the opening price of this up close candle, at 951-ish. So we're in our distribution macro now. That 950 macro is going to move more when you have a tighter open. So if you have a really fast open, that 950 macro may consolidate. Not always, but it may. When you have a really small open or it's consolidating, like the first couple of minutes, it doesn't really move a whole lot. It's a tighter range, or otherwise informally referred to as a barcode pattern, where it's just constant overlap, 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 overlap. Then you're more likely to see further distribution in that 950 to 1010 macro. So as it trades lower, closer below this candle, that becomes a propulsion block. When it's a propulsion block, you really don't want to see it breach the high at all. Most of the time, it won't even reach mean threshold. It does in this case, but we have a fair value gap up there, so it's reasonable to expect that. You can see it gets one little feather above this 830 opening price. Now, one thing that some people have gotten confused by, when I say you want to use the 830 opening price, I don't mean that you have to, for the black belt, see above or below 830 opening price. It's always going to be above 830 opening price if it's sweeping the pre-market high, and it's always going to be below 830 opening price if it's sweeping the pre-market low. Just because 830 is within this range. It's not at the low of the range, it's not the high of the range, it's in the middle. The reason I say you need to use it isn't to filter your entry, because your entry is never going to be affected by the 830 opening price. It's to observe strength and weakness as we're overlapping and trading through that pre-market range. The same goes with the midnight opening price. We're looking, where is it reacting? Why is it sensitive? Here it was a little bit sensitive in that fair value gap. And then as we traded up above it, the 830 opening price, you may have thought, okay, well, it's sensitive to that discount. But it's reaching into the bearish order block when we have all of these factors in alignment to go lower. So in this case, that's not a sign of discount sensitivity. But what is premium sensitivity? When it trades up above this and it rejects, in my mind, I'm thinking, yeah, 100% it's reaching that pre-market low. Nothing's going to stop it. Nothing will stop it at that point. And then it does. Easy. That's the black belt. Isn't that just such a simple model? It swept the pre-market high at 9:30, and it broke down lower into the pre-market low. And all you have to do, your only job, is to get in sync with that move. Isn't that easy? That's easy. This model is easy. Don't let people make you think it's hard. It's easy. But there's a learning curve because you want to time it perfectly to get the high. You don't need to do that. Even if you entered on this first rented fair value gap, you can have a sensible stop loss up here and a take profit at the pre-market low. Plus, you can hold it longer if you're expecting it to go lower, which we were. Okay, we're on the regular trading hours chart now. If you're not using futures and you're on CFD, you will get the exact same information if you look at 414's closing price and 930's opening price. That's all this chart is showing. But it's easier to visualize when we toggle regular trading hours on futures. If you're on CFD, it works the exact same. It's just it doesn't, visually come across the same. So it's the same information. It'll look the exact. Well, it won't look the same, but the information will be the same. So if you see a sweep of the pre-market high and you're looking for it to take out the pre-market low, as according to the black belt, a way you get more conviction of that, and this is taught in the last lecture, lecture number 4, you want to see it trade down into the consequent encroachment of that opening range gap. Now, this acts as a draw. Within the first 30 minutes of trading, you have a 70% likelihood of filling this or trading to it. If it's an exceptionally large gap, that doesn't have the same effect. It still is a draw, but only if the market structure supports it. So when it's a bullish day and it's a large gap, it won't trade down into the consequent encroachment a lot of times. It'll use the upper quadrant, or it'll just play touch and go and it'll tap this and run higher. But if it's a bearish day, it'll run to this anyway, and it'll kind of fill in this gap like a vacuum chamber, basically. So I was looking for lower prices. So everything made sense that, okay, the consequent encroachment is below us. Yes, it's a larger opening range gap, but we can still see it reach the consequent encroachment of this because we're bearish. So it actually acts as more of a pull. And you have, sweeps of pre-market low, that's your black belt. You get the 15th of January's AM first rented fair value gap. Today's first rented fair value gap provides the institutional order for entry drill, market structure shift, partial, and then full profit at the pre-market low. What about all this extra range you missed? Is there a way to capture that? Yes. If you want to hold a runner beyond the pre-market low, which is here, this was the exact level the pre-market low is, I'll show you in a moment. You can, it's just you have to be cautious. Are you counter trend trading? If you're counter trend trading, don't try and push it. Be content with the pre-market low. If you know that the day is going to keep going lower, maybe it's going to fill the rest of the opening range gap, or it's going to go for PM session sell side liquidity on regular trading hours chart or the previous day low, or whatever other sell side objective you have below the pre-market low. If you're confident in that, by all means hold a position because you have the best entry price. No one else has got a better entry price than you. And anyone that did stopped out, stopped out, stopped out, stopped out. But you're trading this model, and this model protects you from that. So when you're seeing this distribution lower, have you got the conviction for it to keep going lower? Yes? Okay then. Hold it. Hold it, hold it, hold it, hold it, hold it. And then boom, you're seeing a huge amount more in extra profit. But the model entails the pre-market high to the pre-market low. I have not yet taught holding the position beyond the pre-market low because it isn't necessary. Yes, you can do it when you're on side with the bias, but you won't always be on side with the bias. Obviously, it's better to be on side with the bias because then you can get windfall victories like this. And it's not like it's a lucky victory if you're on side with the bias and you get a black belt and everything's there in the chart, then that isn't luck. It's skill to be able to execute on that and then hold it beyond the pre-market low. So this my take profit level 803.25. As you can see on the electronic trading hours chart, the pre-market low here is 824 and that is 802. So just a little bit above that pre-market high, or the pre-market low rather. That's slippage for you. So hopefully this has been a useful video. Hopefully it's been useful to see it done live in that New York AM chat this morning. We've done that a couple times, but I thought I'd actually post this on YouTube. So thank you for watching. Hopefully it's been insightful. Hopefully it's been educational and provided more insight into the model. See you in lecture 5. Goodbye.